So you have some taxable dollars to invest. What should you buy? Here are three considerations before making the decision. Hi, my name is Eric Blattner with Divvy Wealth Management. Thanks for watching. Before we jump into the topic for the day, I want to remind folks that if you enjoy listening to our thoughts and comments, the best way to follow along is to go over to our website, divvywealth.com. That's DIVVI wealth.com/blog. And from there, you can subscribe, enter your email address rather, into the box. And anytime we post something new, it'll show up in your inbox. The other way that you can follow along is here on YouTube. Search at Divvy Wealth Management and subscribe. We would certainly appreciate the support. So with that being said, let's turn our attention to taxes and investing. And I'm going to start with a little bit of a story. So a handful of years ago, I had an unexpected tax bill. And that was really about 15 years in the making. So about the mid 2000s, 2008, 2009 timeframe, we started to save on a regular basis in a mutual fund. And one piece of advice that my grandpa gave me years and years and years ago that actually stuck was pay yourself first. And I took that to heart. And so I still think that's good advice for many people getting started. Generally, the best advice is the simplest advice. So pay yourself first. And we tried to do that. And we set up a very basic strategy of a certain percentage of our paychecks that went into a mutual fund and a brokerage account. That was it. And over the course of 10, 12, 13 years, that fund performed really well. And then at the end of the bull market, near the COVID pandemic era, there was a big capital gain that was distributed from that fund, and we owed tax. And it wasn't necessarily on our terms, and we didn't really control the timing or the amount of the capital gain that we had to pay tax on. And so it was a reminder. I mean, I wouldn't call it a learning experience because I think when people invest, generally they know that there's going to be taxes associated when you make money. And I don't want to make this about taxes are evil. We certainly don't want to make taxes the tail that wagged the dog. We would obviously prefer to make a bunch of money and pay the subsequent tax than make no money at all. But we do one of the things we spend a lot of time thinking about is the after-tax returns that our clients will realize, and especially for high income or high earning families and individuals, it can make a real difference in how they decide to invest. So, with that being said, I wanted to kind of use my learning experience as an opportunity to share three different considerations that I think investors might want to weigh before making the decision on how they invest those taxable dollars. And when we talk about taxable dollars, this doesn't really apply to monies that you have in a 401k, an IRA, a Roth IRA, even a variable annuity. I'm talking about a taxable brokerage account, a joint account, a trust account, things along those lines. These are three things that you might want to keep in mind before you decide how to invest. So the first would be style. And when I talk about style, I'm not really, there's a lot of different ways, I guess, to interpret that. It's not growth versus value, large versus small, domestic, foreign. I'm really talking about active versus indexed. A lot of folks might call it active versus passive. I don't want to get into semantics, but generally I think of it as active management or indexed products. Active managers are generally going to try to outperform a benchmark. And they will try to do that over the course of time by choosing to buy and sell certain stocks based on their expectation of what those future returns are going to be. And so that's a pretty typical active strategy. They'll generally have some benchmark that they manage to. Maybe it's the S&P 500 for large cap stocks. Maybe it's a mid cap index, a small cap index, growth value. Could be specific sectors. But they're going to choose pockets of that index that they want to avoid, pockets of that index that they want to own more of, and try to generate a better return with similar risk or a similar return with less risk than that index. That's what they try to accomplish. Index products, on the other hand, don't make the only decision they make is choosing which index to mimic. So if you have an S&P 500 index fund, it's going to try to deliver the performance of the S&P 500. The same could be said for any index. If you look through all the different strategies and products that are out there on the marketplace today, you can find a product that mimics just about any index under the sun. And so these are generally going to be, again, some folks call them passive strategies, index strategies, however you want to think about it. There's very little trading that goes on here. And so bringing this back home, the first consideration that you want to make is that active strategies are generally less tax efficient than indexed strategies. And the main reason for that is they will do more trading. Trading, buying and selling, generally realizes gains and losses. Over time, the market's typically up, or at least historically has typically been up. So as they sell, they're realizing those gains, passing them on to shareholders, in which you will owe tax on those gains. The indexed funds, on the other hand, do very little trading. They will occasionally rebalance, and so they can pay gains, but generally speaking, historically, those gains have been much, much smaller than their active counterparts. So that's the first consideration. Um, the second piece is really the investment structure. And so when we talk about structure, there's a couple main ways that most investors can get access to public markets. When I say public markets, I'm talking about the US stock market, the US bond market, international markets, stocks like Apple, Amazon, things that we're all going to be familiar with. I'm not talking about the private investments, private real estate, private equity. I'm talking about structures, pardon me, that folks generally have access to via online brokerages, via their wealth advisor, things along those lines. And so one of the more common structures is a mutual fund. This is generally going to be an option for folks that are employed or are business owners with a retirement plan. In many, many cases, those retirement plans are going to be populated with mutual funds. Same can be true. You can buy the same mutual funds, generally different share classes, but the same strategy, the same fund in a taxable brokerage account. Now, mutual funds have a lot of benefits for investors. They give you diversification into broad markets. They give you professional management. In a lot of cases, they take less risk. And there's some evidence that suggests these actively managed mutual funds will protect better in down markets. That's not always the case. Of course, there's no guarantees, but there is some evidence that suggests that might be the case. So with the mutual fund, for all the good things that it brings to the table, one of the bad things is the structure is required every year to distribute realized gains at the end of every year. I'm recording this on December 6th, 2023. And it's about this time of year when many folks will start to receive capital gain distribution from their mutual funds. If you own these funds in a taxable account, you will owe capital gain tax. You'll owe tax on those distributions. The nature of those gains will determine how much you pay. If it's a long-term capital gain, those are going to be taxed at long-term rates, which are generally going to be 15 or 20%. For those really high income earners, you could tack on an extra 3.8% for that net investment income tax. If they are short-term capital gains, that's going to be taxed at ordinary income rates. And again, the highest tax bracket today is 37%. Again, those folks will be subjected to the additional 3.8%. So we're talking 40% tax before you really consider state and local. So that's a pretty big bite. And from a structure perspective, it can be punitive for those higher income individuals, especially because you don't have control. You don't get to determine when you pay tax, when you realize gains. It's completely dependent upon how those funds are traded. And most of the portfolio managers that I have known or that I have run across in my career, they have a fiduciary responsibility. They have a mandate to outperform their benchmark. Taxes are a secondary consideration, if that. Their job is to outperform the index. And so they're going to make decisions within that portfolio, as they should, that they believe are in the best interests of those shareholders in outperforming that index. So that's my interpretation of how the mutual funds could potentially benefit, or in this case, hamper returns for high income earners. The other structure, or one of the other structures that a lot of folks have access to, is an ETF or exchange traded fund. Without going into the detail, there are some unique advantages to this structure that allow the managers to basically pass off those big capital gains to a third party. And what that means for the investor is that if I buy shares in an S&P 500 ETF and I own it for say 20 years, there is a very, very good chance that I will not have paid any capital gain tax from point A to point B. Now, I will certainly have paid some tax on the dividends that I receive over time, but I get to control when I sell, when I realize those gains. And I think the ability to control taxes, to keep it on your terms, is an advantage. Perhaps there's some years where you might have losses that you can use to offset those gains. But regardless, I think having a structure that allows you to control the timing and the nature, long term or short term, of those realized gains is a big benefit. Lastly, I'll just mention that there's a newer structure. I don't even know if it's correct to call it a structure, but we talk about mutual funds, active index strategies. So generally with indexing, you would buy the entire index, and I'd see it as one line item on a statement. So if I wanted to buy the Vanguard S&P 500 index fund or the Vanguard 500 ETF, it would show up in my statement as one line item. I would just see the mutual fund. I would see the ETF, the number of shares, the share price, and the value, something like that. A relatively newer concept is called direct indexing or custom indexing. Instead of having that one line item, I'm going to actually own little slices of all those individual companies within the index, or most of those companies within the index. Why would you want to take that path? Because generally, what we're trying to accomplish there is to earn the index-like returns, but you're going to be able to, at least the idea would be to take advantage of some of the stocks underneath the surface that are struggling year in and year out, selling those, realizing losses to offset gains. Long story short, the idea would be that you have similar returns as those index fund before tax, but after tax, your returns are a little bit better. That's the idea. So, long story short, structure is something that I think taxable investors ought to take seriously because there's a lot of good options out there for folks that have taxable dollars that earn a lot of money to basically defer that and pay those tax dollars on their terms. And then finally, the last piece is selling. And again, I think this is I kind of hinted at this in the last piece around custom indexing, direct indexing. In any given year, there's generally going to be pockets of the market that struggle. There's going to be individual stocks that struggle, and I think as investors realize those gains over the course of time, if you realize up to 3,000, that can be used to offset income in a given year. So again, if you, let's say you're paying roughly 30% in federal tax and you have $33,000 in losses you can offset, you just saved yourself, almost $1,000 in tax. But more realistically, you're going to be able to book some of those losses and offset future gains. The opposite may also be true. Tax gain harvesting doesn't get nearly as much publicity, but in certain situations, individuals may have low income years. Perhaps you're starting a new business or you're in a transition period. There's a lot of different reasons why folks might have a dip in their income in their professional earning years. And it might be an opportunity to realize gains and potentially pay lower tax. Believe it or not, there's actually a bracket for for married couples in particular. I'll just use this as an example. It's about $83,000 next year. If your taxable income is below that threshold, your capital gains are taxed at 0%. So there's an opportunity there to potentially realize some gains and save yourself some money in the long run. So again, we don't want taxes to be the tail that wags the dog, but we do care a great deal about not just the returns we earn, but the returns that we keep. So to the extent that we can enhance our returns, keep more of what we earn, we think ultimately that's a good thing. So hopefully you've enjoyed this. If you find it helpful, again, the best way to follow along is to go over to our website. That's divvywealth.com, DIVVI wealth.com, and check out our blog. From there, sign up with your email address, and you should receive all of our posts real time as we make them live. Or you can go over to YouTube and search at Divvy Wealth Management. We would appreciate your support. Subscribe there, and if you have any questions, please reach out. Thanks for watching. Bye-bye.